Welcome to Taking Stock for the week ending 2nd of September 2022, where myself, Tim Lincoln, and our head of research, Kien, Trinh, stream to you all things share market. But before we get started, just need to read out our usual disclaimer and let you know that all of the information we share today is of a general nature and should not be relied upon as a guide of personal advice. And all of the data and performance figures that we share also is of an historical nature and also shouldn't be relied upon as a guide for future performance. Well, Kien, we've reached the end of the Australian reporting season and corporate profits and balance sheets remain in really good shape. Inflationary cost pressures, especially with labour and materials, have presented challenges, but companies have found ways to offset higher costs by increasing prices and improving operating efficiencies.
Yes, Tim, those high quality companies, and a good example is borderline style growth stock, Brambles, which operates a pool of 340 million pallets, crates and containers across 60 countries, and they use it to transport groceries and other products to retailers. But the company was able to absorb a 40% rise in timber costs by passing on price rises and surcharges, enabling them to generate 21% in earnings growth. And they've invested in supply chain productivity and digitization as well to reduce waste and improve efficiencies. And this helped the company maintain net profit margins at a very high 9.8%.
Wow. It's pleasing to see, Kien, that we've begun to see cost inflation moderate across key sectors. The supermarket chains and star income stocks Coles and Woolworths mentioned that food inflation would moderate in the second half of the year, and this should help them sustain their dividend yield of around 4 to 5%. Commodity prices have also reversed, but this could put pressure on the huge dividend payouts from the resource companies like BHP and Rio. The gross dividend yield on these stocks lied a whopping 13%, providing adequate buffer above the market yield of around 4%.
Yeah, that's right, Tim. If cash flows reduce and they had to cut their dividends, the yields are still very attractive there. But as shown with the chart on screen, earnings growth for the market, and that's in blue there, is expected to moderate this financial year. And that's mainly driven by negative earnings growth across the resources, as you've highlighted, Tim, especially as commodity prices weaken. And with the economic growth expected to contract, earnings growth for the banks should also moderate as well. But for now, with unemployment levels at record low levels, we do not see a threat to their dividend payments, which remain quite attractive at between 6 and 7%. And along with the banks, we expect to see earnings growth slow for listed property as rising interest rates lead to higher debt costs and also lower property valuations as well. Hence the reason why we recommend investors look at the REITs that can grow earnings through unique niches, such as childcare, for instance, industrial, and even service stations. And these are some of our star income stocks like Arena REIT, Waypoint, and even Charter Hall Social Infrastructure. Now, interestingly, though, earnings growth across those industrial sectors, and that's where we look at for true growth stories, such as in transportation, IT, healthcare, and capital goods, they are expected to improve. And this is most likely driven by the easing supply chain pressures. But with that said, the average earnings growth rate across our star growth and borderline star growth stocks for this year is well above the market at 16%. Now, meanwhile, one of the key sectors facing a lot of challenges at the moment is the retail sector, but they've been quite resilient over the reporting season, with consumers continuing to spend despite inflation and rising interest rates. In fact, retail sales climbed to 1.3% in July, and this was in line with the performance of our star retailers like JB Hi-Fi, Baby Bunting, Lovisa, and even Adairs, who reported positive like-for-like sales growth for this financial year.
Fantastic, Kien. But one of the big issues still facing retailers is the management of supply chain issues, with many increasing their inventory at the expense of declining cash flows. This leaves them vulnerable to write-downs and capital raisings. down the track if consumer spending slows from increasing interest rates. To avoid these risks, I see your team have removed stocks like Brambles Group, ARB Corporation, and GUD Holdings from our Star Growth stock universe. Also, Kien, we've had to say goodbye to a few of our star stocks this week, including salary packaging firm SmartGroup, gold producer Northern Star, financial advisory business MA Financial, and Domino's Pizza. That's the churn we all see in reporting season, and that's why we've got to stay right on top of our portfolios. We've also initiated coverage on lithium miner Alchem and oil producer Santos. For a full rundown of all of the star stocks ins and outs, and also further explanatory commentary on the rationale behind some of these removals, please visit and read our commentary on the 9 golden rule screen for each of the stocks mentioned. But let's take a quick look, Kien, at salary packaging and fleet management company SmartGroup. So tell us why did their financial health deteriorate, Kien?
Without bogging down into the details, Tim, the company historically has a very high percentage of intangible assets on its balance sheets. And this is due to a generous amount of goodwill from past acquisitions. Remember, intangibles aren't physical assets, and it makes the company susceptible to small changes to its debt profile. And what we saw a rise in borrowings, which push its financial health over the edge, Tim.
Yeah, we don't want to see that increase in financial health, do we, Kien? That's golden rule 1, and that's when we really just have to pull the curtains down, unfortunately. So turning now to some of our outperformers, and borderline star growth stock IDP Education released a really solid result. For those not familiar with the company, IDP is the owner of the International English Language Testing System, or IELTS, is the acronym, and it's designed to assess the language ability of people with goals of studying, working, or living where English is the language of communication. And the company also places international students into educational institutions in the main English-speaking countries. So, Kien, how did the company maintain strong earnings momentum despite border closures in Australia and a breakdown in the China-Australia relations?
Yes, Tim, it was facing quite heightened risk there, but it was able to generate a significant uplift in its return on equity to 25%. And that's by diversifying student placements into other destinations as well, Tim, including Canada and also the UK. And furthermore, IDP, they derived an additional revenue stream from the recent India English test acquisition, which offsets some of the current difficulties in China-Australian relations.
Okay, and I also noticed, Ken, I don't like short interest at these levels, but it's crept up to about around 8% of the total share registry, which, as I said, is pretty high. So is this high short interest level a concern for investors, Kien?
Yes, we've been paying attention to that, Tim, but we feel the short interest is due to the risks regarding the slower recovery in the number of international students returning to Australia. And that's on those risks you mentioned, the China-Australia relationships there. But its strategy of diversifying revenue to other countries has somewhat mitigated this risk. Hence, when you look at the current discount to consensus price targets of around 18%, that could represent an opportunity for those long-term investors.
Yeah, excellent business model, and things keep on getting better there in a challenging environment. And another stock to report really well was media owner Nine Entertainment, Kien. Since April, the stock has been sold down on fears that advertising revenue would be impacted by slower economic growth. With the earnings outlook negative, will the dividend be sustainable?
Yes, Nine generated a strong uplift in its earnings of 34%, and this translated to a 17% return on equity. Although future earnings growth could be weighed down by that weaker advertising spend, and we are watching this closely, the company has transitioned its business, remember, towards those digital channels as well via Stan and also domain.com, which collectively make up about 27% of their revenue. And with regards to those dividends, Tim, we prefer to look at free cash flow, given that dividends are paid in cash. And the forecast free cash flow of around 23 cents per share is well above expected dividend payments of around 14 cents per share. Hence, we believe that gross dividend yield of 9% remains quite attractive. Note also that the stock goes ex-dividend on the 9th of September as well. Now, looking at ex-dividend dates as well, with the reporting season over, there are no star stocks reporting. However, the analysts continue to scour the results for potential star stock inclusions, and they'll be coming in over the next few days. But on the dividend front, the star stocks expected to go ex-dividend include retailer Adairs, Bendigo and Adelaide Bank, also another retailer, Super Retail, Oz Brokers or AUB Group, and Medibank, and of course the ASX exchange.
And now to Under the Microscope, Kien. And this week for Under the Microscope, we focus on star growth stock Lovisa, a global retailer in the fast fashion jewelry segment. The company was able to defy rising interest rates and supply chain pressures by delivering an earnings growth of 132%. Outstanding. How did they achieve such a terrific result, Kien?
Yeah, that was an enormous earnings growth rate, Tim. But with lockdown restrictions easing, if you think about it, consumers were able to go out, they were able to buy cheap jewelry to attend concerts, functions and events. In addition, the company rolled out 85 new stores and generated increased sales through their online platform, which also helped improve their net profit margins to 13% from 9%. And furthermore, they implemented price increases in the third quarter, and this also had little impact on their volumes.
Incredible, Kien. And what is also incredible is one of our main Golden Rule 2 and Golden Rule 3 criteria being return on equity, that for Lovisa is now over 100%. Is this sustainable, Kien?
Yeah, very few companies can generate this much return on equity, Tim. But if you think about it, it's due to their capital-light business model and vertically integrated supply chain, allowing them to manage the cost of goods sold pretty well. Its products are cheap, and it's quite easy to transport and are sold at significant price markups as well. In fact, the outlook suggests that the company should continue to generate a return on equity in excess of 100% over the next 2 years.
Wow. I noticed also, Kien, that the stock has positive earnings revisions over the last 3 months on the back of stronger than expected like-for-like sales for the year to date of 21%. But the company has a 31% exposure to Europe, where consumers are facing an energy crisis from the UK and Russia conflict. So investors should be mindful of this active risk. Under Golden Rule 7, I noticed that Brett Blundy has a significant stake in the business at 40%, Kien. Who is Brett Blundy?
Yes, Tim. Brett Blundy is an Australian billionaire. He's an entrepreneur who has a strong record of investing in wealth-creating retail businesses. Remember, he founded what we call BB Retail, which was the owner of stores like records and music store Sanity as well. He's also the director of shoe retailer Accent Group and discount store Best and Less. Brett is currently the co-founder and non-executive chairman of Lovisa. And of course, he has a large stake in the business, providing high conviction in this investment opportunity.
And now to question of the week, Kien. And with reporting season now over, a good question is, how can Stock Doctor help members look for opportunities from the reporting season? And members can look for star stock opportunities by utilising our stock filter, which lies under the Tools tab. Here you can easily build your own filter or select from a list of predefined filters such as Star Growth Stock or Star Income Stock filters.
Yeah, that's right, Tim. For growth stocks, within the field list, make sure you include, say, for instance, EPS growth 1 year forecast. Another field is price change 3 months, and a technical indicator such as the SD30 TSR and EPS forecast 1 year 3 month revision. So that's the revision to forecast as well. And of course, also the number of analyst coverage to help you understand the reliability in those forecasts. And in general, stocks that perform well over the reporting season have had upgrades to their earnings estimates. And you can see this from that list. Some of these growth opportunities include IGO, we had WiseTech, Altium as well, Lovisa, which we've mentioned, and also Brambles. But to look for oversold opportunities, you can look for those stocks with stable or rising earnings revisions, but have also breached, say, the SD30 TSR, which is the 30% stop loss. And these include ResMed, car sales on there, net worth, and also Aristocrat Leisure and West Farmers.
And for income-seeking investors, Kien, within the stock filter criteria, you can also include fields like dividend yield forecast, franking credits, forecast dividend payout ratios, and days to ex-dividend date. Here, sort companies by the highest gross dividend yield and look for those with stable 3-month earnings revisions to provide that comfort. Some of these opportunities include Woodside Energy, Deterra Royalties, Bank of Queensland, ANZ and Suncorp. And of course, you can also use our watch list with the predefined watch list layouts there for star growth stocks and income stocks that have similar fields already laid out for you as well. But that concludes another episode of Taking Stock, and that supports the conclusion of reporting season, Kien. I thank you and your team for the dynamic distribution of all of our stock updates. That includes, the new inclusion to star stocks and quite a few star stocks being removed from our universe of stocks because of all of the risks that you clearly articulate in this challenging environment that's set to last for a little bit longer. So thank you on behalf of the business and all of our members to you, Kien, and your team of analysts.
It's a pleasure, Tim. I mean, we're constantly trying to improve our commentary to make it easier for our members and make it, easier to understand. So constant improvement here at Lincoln, Tim.
Yeah, and constant improvement, Kien, and that dynamic delivery of information hot on the heels of when companies release their results for over the 2,000 companies. So great stuff. Thank you. And also, Kien, we'll be back into it on Monday morning, won't we? With Rob Manfrey and Matthew Schwartz for Lincoln Live, where we answer live all of your burning questions relating to stocks and strategies. So to summarize, Kien, the reporting season is over, but it's been a really good one despite those challenging economic conditions. So use Stock Doctor to assess the financial health of companies, because we've seen some deterioration in businesses, and look for those wonderful high quality companies that have been oversold on the back of the challenging economic environment. Take care, have a happy, healthy and prosperous week.